Welcome to the latest episode of Damien's Market Update, the show where I talk about what's been going on in investment markets and what to look out for in the days and weeks ahead. Now, I can't believe it's been a month since the last show, but a lot has actually happened in that time. Don't forget, if you find this useful, hit that like button, but also subscribe to the channel. Now, in April, there were signs starting to appear that investors were rethinking their narrative, and there was fear that was starting to drive their behaviour. And we started to see rotations out of sectors that had performed well in January and February into previously lagging ones, such as energy, and European and UK stock markets outperformed those in the US. So that's in contrast to earlier in the year. Now, while those rotations aren't necessarily a bad thing for a bull market, it was notable that equity investors began favouring those more defensive sectors as April progressed. So, for instance, if you looked at the S&P 500 sector performance in April, you would have seen that utilities was the only sector with a positive return of 1.66%. Meanwhile, other defensive sectors like consumer staples fell just 1.13%, which outperformed more cyclical ones like consumer discretionary, which fell 4.5%. Tech stocks slumped with earnings from some Magnificent Seven members, particularly Meta, failing to improve the situation. Consequently, the S&P 500 fell over 4% during April, which was quite a pullback given where we've been so far this year. However, it wasn't a complete disaster. Diverging interest rate expectations among central banks, with the Bank of England and the European Central Bank deemed most likely to cut rates before the US Federal Reserve and the Bank of Japan, influenced currency and equity markets. Now, this divergence meant that stock markets with more accommodative central banks performed better. So, for example, in April, the FTSE 100 outperformed and it finished the month up 2.41%, while the US and Japanese markets lagged behind the UK and European markets. Gold was also a standout performer for much of the month. Now, the good news is that in May, global stock markets appear to have turned a corner. So firstly, this has been helped by reduced geopolitical tensions after the US urged Israel to agree to a ceasefire with Hamas, and that helped boost sentiment. Then, after the Bank of England announced that the Monetary Policy Committee had voted to keep the base rate at 5.25%, the meeting minutes revealed a split vote, with 7 members voting to maintain the rate and 2 voting for a 0.25% cut. Now, this hinted at a potential rate cut soon, which obviously buoyed UK equities. And the Governor of the Bank of England, Andrew Bailey, expressed optimism about the economy's direction, and the market now anticipates that first base rate cut to be as early as August. US equities have also performed well in May, driven by weaker than expected employment figures at the start of the month, which fueled hopes for looser monetary policy. In addition, the latest US inflation data, which was released actually last week on the 18th of May, reinforced the belief that the US is making progress in its battle with inflation. Now, the CPI, which is the Consumer Price Index for April, showed a 3.4% year-on-year increase, which was slightly down on March's figure of 3.5%. But importantly, the 3.4% figure was in line with economists' expectations. So this boosted investor confidence of rate cuts potentially in the future, which is obviously good news for US stocks. And it means that even the Magnificent Seven are starting to shine once again after a disappointing period in April. And this has all helped to propel the S&P 500 and the Nasdaq 100 to new all-time highs. We've even saw an all-time high on the Dow Jones last week. Similarly, the FTSE 100 set its own all-time high in recent days with an even more impressive breakout. It just goes to show that this isn't a US story. This is something that we're seeing globally, such investor optimism. And it all means that currently investors are in a sweet spot because there is that optimism over corporate earnings, which are driving things higher alongside the anticipated rate cuts, decline in inflation, and of course, some of that easing geopolitical tension. And that's causing stock markets to rally, but also we're seeing bonds start to perform. So we saw the 10-year US Treasury yield, for example, fall from 4.7% to 4.4%. So that showed a broader enthusiasm for bonds. And we've also seen gold pushed to all-time highs. So it almost feels like whatever you're invested in is doing well right now. And perhaps unsurprisingly, my own 50k portfolio, which I run on 80/20 Investor, reached a new all-time high of its own this week. It's had a number of those in recent months. However, there is a potential risk that looms this week in the shape of Nvidia's Q1 earnings report. Now that comes out on Wednesday, and investors view Nvidia's results as a key indicator on the sustainability of the broader stock market rally, but also the whole AI theme. Now, since November 2023, Nvidia has contributed roughly 15% of the S&P 500's gains, which is more than any other company. So if you wanted to sum this all up, in April, investors were in the grip of fear, but in May, they are well and truly being driven by greed. So if you found this useful, do make sure if you're watching on YouTube, you hit that like button, but also subscribe to the channel. And if you're consuming this as a podcast, then please do make sure you give us a 5-star review on your podcast app of choice.